Hello. Thank you for taking the time to listen in today on our 2025 halftime report. I cannot believe, Bepin, I cannot believe half the year is behind us at this point. It has been a wild
Time
first
flies when
half
you're
of the
having
year.
fun, right, Mike?
It's fun, honestly, Bepin, I mean, look, if let's say you fell asleep for 6 months, you fell asleep on January 1st, woke up today, you'd have been like, another great year in the market.
Normal year, exactly.
Normal year. Hey, it's going great. Everything is moving along as expected. You would have completely missed Liberation Day, completely missed all the volatility and the panic and the tariff talk and all that other stuff that has caused people to have a very, very crazy first half of the year. So I think the question now becomes what's going to happen in the second half? And that's what we're going to do today. Is we're going to talk a little bit about what's going on right now and some of our expectations through the end of the year. I love to start quotes by Jim. I'm sorry, start presentations with quotes from Jim Grant. So, for those of you that don't know who Jim Grant is, that's fine. Most of you probably don't. Jim Grant is the author and editor of Grant's Interest Rate Observer. It's a publication that only the biggest geeks on Wall Street read.
I was going
Only
to
the
say I've
biggest
never heard of
ones.
that.
Yeah, we're talking like this is back from my institutional days, and it's a very, very expensive magazine. Publication, and he is extremely closely followed by all top managers in the world. I mean, he's one of the most eloquently. He could take these subjects, these very, very unique financial subjects, and explain them in a comical way, oftentimes, which I have for you today, from Jim Grant. To suppose that the value of a common stock is determined purely by a corporation's earnings, discounted by the relevant interest rate, and adjusted for the marginal tax rate is to forget that people have burned witches, gone to war on a whim, risen to the defense of Joseph Stalin, and believed Orson Welles when he told them over the radio that the Martians had landed. All right, what is he basically saying very sarcastically is that if people think that stocks are driven purely by the fundamentals, revenue, cash flow, things of that nature, and it's only fundamentals, then you have not been paying attention to markets. So many
Or
times,
humanity in general.
humanity in general, we're talking about just incredibly emotional creatures making emotionally fueled decisions at all times. And that's what we have to separate. The near term, which is predominantly driven by emotions, and the long term, where those fundamentals kick in that Jim Grant is talking about. So it's just a reminder for everybody that even after the first half of this year, what we saw, I seriously doubt that a lot of fundamentals caused the market to whipsaw the way it did. It was purely emotional.
For sure.
But we sit here today, and this is a great place to be, even with all that volatility in March and April. We're at all-time highs again in the stock market. And Beth, I don't know how many times we've talked about this, but I think it's a good reminder. All-time highs happen all the time. Okay, remember that. All-time highs happen all the time. And I think the natural inclination, our emotional self wants to say, okay, wait a minute, stocks are at an all-time high. They're too expensive. It's time to sell. Let's look for a million reasons to get out of these things. And like most times when it comes to investing, your natural instincts tend to be misleading. All right, we all do it, myself included, happens every once in a while. But all-time highs, ironically, are some of the best times to own stocks. Look on the left-hand side of this chart. I know it's a little squeezed, but basically what we're saying here is, as I mentioned, all-time highs happen all the time. Look at that chart. Every single green dot you see in that chart, which, by the way, doesn't look like a green dot, it looks like a green line because they happen so frequently. But what you tend to see is these all-time highs eventually over time turn into a floor for the next leg higher. Okay, so they tend to be almost like a support structure of sorts for the next leg of a bull market or the next move higher. And I think that's a really important point to bring out. But what's also I found very interesting, because we've done some analysis on the data here that's not in this chart. All right, it's not just that all-time highs happen all the time. It's not just because we tend to see moves higher, but the interesting thing to me about it is, or what's so impressive, is how stable the market has been at all-time highs. The stability to me is shocking in many ways. Since 1960, here's a fun one. Since 1960, there have been only 3 times when the market has gained more than 2% in a single day off an all-time high. All right, what we're saying here is that when you hit an all-time high the next day, doesn't really tend to move all that much, good or bad. The stability, what's happening? You're seeing it in this chart right here. It's building the market floor. Slowly and steadily, it's creating that support structure for the market to go higher.
I think what's more interesting is that chart on the right showing that you're actually better off investing on all-time highs than relatively any other day in the market. That's pretty insane. It's very counterintuitive, like you said.
Yeah, and it's pretty consistent too over different holding periods, 6 months, a year, all the way to 5 years. Again, all-time highs happen all the time. And guess what happens all the time? Yeah.
Yeah.
Exactly, right? What happens all the time? Volatility, crazy markets. All right. So this chart, this is a staple for our analysis. It's also a reminder for us. You go back, this chart is going back to 1980, but believe it or not, if you go back another 30 years, this chart can go all the way back to 1950, if I remember correctly. And what it's showing is that those the blue bars rather, the blue bars are the annual return for the S&P 500 every single year, okay? Now, I think first and foremost, somewhat off subject, is that I find interesting that almost every single bar, with the exception of very few, are up above zero. All right, so that bodes well to this idea that the markets tend to go up over time. But what I think is even more interesting is that every single year going back to 1980, and I tell you, if you go back to 1950, it's going to look exactly the same. Every single year has a red dot. Every one. Why? Those red dots represent drawdowns. Okay, at some point throughout the year, the market drew down from a point in the S&P 500. Every single year for 45 years. Again, add in it, go back another 75 years if you go back to 1950, same thing. Okay? Volatility is a feature, not a bug of the stock market. Without volatility, you cannot have those blue bars up so high every single year. It doesn't work like that. All right, we're going to pound this. We're going to continue to talk about this over time because it's an important thing to remember. We need volatility. If we don't have volatility, then we've got a problem. That's what we want to worry about, is when things are not volatile. I also think another underlying current of the year that, yeah, I guess it got a little bit of press, but not as much as you might would have expected. The dollar. So I'll give you an example, Bepin. I remember planning my first European vacation with my daughters. They're 6 and 8 years old. My wife and I talked about doing this at the very beginning of the year, back in January. But I'm really cheap, so I went online and I looked and I said, okay, well, right now the euro is at really, I mean, very close to parity with the dollar at the very beginning of the year, late last year, somewhere in that range. And I'm thinking, wow, that means the European vacation is going to be pretty cheap. So you know what I did? I booked it. Booked it for late March, early April, somewhere in that range. And guess what happened? By the time I got to March or April, that vacation got a little bit more expensive. And I wasn't too happy about that. All right. And I think that example is emblematic of what we saw throughout financial markets. We saw a surge in European markets and called international markets. And we saw, I like to think some level of that volatility we saw this year, I do think could be attributed to the fact that the dollar moved. Now, the US dollar goes up and down all the time, like everything else, okay? And as we'll talk about, a weakening dollar isn't necessarily a bad thing. A lot of times that could be very good for the United States. But I think what caught everyone off guard, Bepin, was the speed at which the dollar moved.
Yeah, I think it's the fastest on record in terms of a drop in the first 6 months of the year. No.
I mean, we blinked. I mean, look, currencies don't move that. I mean, they move, yes, but they don't move like this. It's very, very rare to see that. And there's a number of factors, I think, that we don't really know for sure, right? We could sit there and hypothesize. I could tell you it's because of the deficit or because of tariff talk or because of a million other things that were going on at the time. It's probably a mix of a bunch of those factors altogether. But the reality is, the reality is that the dollar is weakened. And again, we have this tendency to think, well, if something's weak, it's not good. It doesn't always mean that, all right? For example, if the dollar gets weak, that means our exports, okay, our exports look far more attractive to countries where the strength of their currency is rising relative to ours because they can buy more of our stuff. Okay. Furthermore, S&P 500 companies, I don't have the statistic in front of me, so I might be off a little bit here, but roughly I want to say 38 to 45%. Is that right,
Yep.
Bepin?
Yes, in that range. Yep.
Right in that range of revenues actually come from overseas.
Exactly.
So, it's not necessarily a bad thing per se, but what we want to watch to see is this one of those, the dollar has cycles like everything else. And there's been a couple of defined cycles of the dollar over the past several decades, kind of like how interest rates have moved up or down. So we're curious to see where this goes. A lot of it's obviously going to depend on the budget, the economy, the deficit, and a million other variables that we're just going to have to watch. But for now, it has certainly impacted financial markets across the globe.
Yeah, exactly. And obviously, as Mike mentioned, it's not all bad, right? So for diversified investors like ourselves, I mean, we do hold international stocks, which have outperformed quite a bit this year. So it's been a great tailwind to our portfolio. So if you've been looking at your accounts and wondering where some of that outperformance is coming from, well, look no further.
But we all know what happens anytime the dollar moves.
Exactly.
Especially when the dollar weakens. This is the same subject that comes up all the time. The pundits on TV start talking, they start going crazy about this idea that the dollar is falling apart, it's losing its reserve currency status, gold's going through the roof, Bitcoin's going through the roof, and this is it for the US dollar dominance. And I'm here to tell you that is absolutely not going to happen. I will not use the word G because of compliance. I can't use the G word.
Yeah.
But in my lifetime and my kids' lifetime, I would be willing to bet my house that the US dollar will remain the world's reserve currency. There's just too much staying power. Look on the left-hand side of this chart. If you look, roughly speaking, 88%, give or take, 88% of global trade is done in US dollars. Okay. What does that mean? If Bepin is Vietnam and I am Saudi Arabia, Bepin doesn't trust my currency and I don't trust his. So what do? We agree to transact our oil in US dollars.
And I'm glad you mentioned Saudi Arabia because we do once in a while get some questions about the petrodollar, and quite a ridiculous concept, to be quite honest with you. There's just no chance, not just only that the US dollar won't lose its dominance, but it sure as heck won't be to a petrodollar. So if anybody's worried about that at home, you can rest assured.
3 years ago, I think China tried to pay Saudi Arabia in Chinese currency. Yeah. And Saudi Arabia said yes. How long it'll last?
Yeah, months? Exactly.
I don't even know. And mind you, China was Saudi Arabia's largest customer, right? So if your largest customer says to jump on one foot and kind of sing out loud, you're going to do it, right? And they did it. And guess what? It didn't last. I forgot what it was, but it was a couple months, maybe not even that. So anyway, my point here is that dollars move the world. Furthermore, if you look at at central bank reserves, okay, so if you look at central banks like the European Union Central Bank, Japan Central Bank, Saudi Arabia Central Bank, you go on and on and on. Roughly 60-ish, 62% of all the currency stored by central banks across the globe are US dollars. The second largest currency, if I remember correctly, is the euro at about 20%, maybe 22%, somewhere in that range. So mathematically, there isn't enough currency out there to replace the US dollar without a massive weakening in the currency. Look, it took 8 decades for the US dollar to get where it is. It's not going to unwind in 8 days or 8 years. It's just not. And then we get to next steps. What's going to happen next? I think this is where the fun part, Bepin gets to do more of the fun stuff later in the presentation, but I think it's important to understand where we're sitting from an asset allocation perspective. Because cash has paid so well over the last, call it 2 to 2.5, 3 years now, there's been somewhat of a hesitation to walk away from cash, right? Why would I leave cash pay me 4.5%, which I have nothing to worry about, and go in an asset that it's risky to get another 1 or 2%? Doesn't make any sense. I'm going to stick in cash. And I think that honestly, Bepin, has been very difficult to debate that mentality, and we've kind of supported kind of a certain level of cash in most financial plans. But I think what we're dealing with right now is a massive, massive amount of cash, what we call dry powder, sitting on the sidelines. And our opinion is this cash is going to have to get put to work here relatively soon. But I saw the statistic that Bepin, you actually pointed this out to me. I couldn't believe it. Over the last year, on the left-hand side, over the last year, more money has gone into money market funds than all mutual funds and ETFs combined. Wow. That is just an absolutely staggering concept. And honestly, like we said, I mean, it's been producing pretty stable returns. But here's the problem. Here's the problem, Bepin. All right, let's say you're earning 4% in cash. You know what? Screw it. Let's get aggressive and say you're earning 5% in cash. All right. So my question then becomes, well, half of that, roughly speaking, depending on where you live, it's going to go to the government for taxes. Okay. And then what's left? Let's say 3% is left. Let's be generous. Okay. After 3%, then you got to deal with inflation. So my question is, who believes out there that their personal rate of inflation is under 3%? Because if it's not under 3%, then you're losing money safely. That's effectively what cash is doing for you. So I think that there's some fundamental issues with cash as it stands, but I think, Bepin, going forward, it might get a lot more difficult for clients. And this is somewhat of a call to action now to think about, am I sitting in too much excess cash?
I mean, just looking at that chart over to the right there, 93% of all bond mutual funds and ETFs have outperformed cash over the last year. So just in the last year, I know it doesn't look like a lot, but that's almost a 2% difference in terms of performance if you've just been in bonds versus leaving it in cash. And then kind of going towards more forward looking here, this is another reason why we would recommend that if you are parked in a lot of cash right now, it may be time to look to get that working a little bit harder. Well, not saying let's go dump that into the S&P 500, but at least let's start looking at bonds. And this is one of the biggest reasons why. What you're looking at here is the expectations for the Fed funds rate over the next 2 years, or the rest of this year and the rest of 2026. By the end of this year, the market's expecting about 2 cuts. Now we'll see what happens here. Obviously, one of the big 2,000 some pound elephant in the room here is what happens with Powell. Obviously, if he's replaced, we could see a much quicker drawdown here, a much quicker pace to getting to 2%. I mean, heck, I think the president was talking about potentially 1%, but we'll see about that. It seems like right now they've cooled off on trying to get him fired. But point being here is we expect rates to come down. So does the market. So does basically everybody at the Fed. They expect at least 2 cuts the rest of this year, and then 3 by the end of next year, bringing us down to about 3%. One place you'll notice this immediately, it's in your money market funds. Those will adjust almost same day you hear about the rate cut. You'll get a notice saying, hey, the yield's coming down. Going forward here, this is why we're pushing to get into bonds right now. What you're looking at right now is looking at starting yields over the 5-year forward return. Basically, a lot of fancy words for saying whatever bonds are paying you today, or the yield, whatever that's paying, it is probably going to be a return over the next 5 years. So when we look at it right now as of June 30th of this year, or actually this is the last year, but still roughly around 5% is the yield. If we look 5 years forward, we can't use that G word, but we can feel very highly confident that the average return over that 5-year period is going to be 5%. Now, another thing to really focus on here is this is just if everything stays constant. And like we talked about in the last slide, we expect interest rates to come down, the federal funds rate to be lowered a couple times this year, a few more times next year. And let's just take a look at what that does to bond returns. So when you're looking at your money market, the most equivalent on this chart would probably be that US short. So what it shows is that as rates get cut down, if you look over to the right there, from flat to yields decreasing, it adds a little bit of leverage almost to your return here. So if you're just moving out into the US aggregate, the most vanilla bond index you can find, a 1% rate cut, you basically get another 6.1% in return, just for 1% in rate cuts here. So you get your 5% that they're going to pay you in interest, and plus you get something called price return. The value of your bonds are going to go up, we really like this proposition. And even if you look all the way down here to the US long, which a lot of our portfolios do hold some long duration bonds in there. And it's all because of that idea that we might not know when rates are going to get cut, but we're very confident that by the end of next year, we're going to be at a much lower rate environment than we are today. And our thinking is, why not pick up that extra return? I mean, if you look at a 1% rate cut all the way there at the bottom for the US long bonds, a 1% rate cut, that's like S&P type returns there, 18.8%, while earning almost 5% in interest. So it's a very attractive proposition for us right now. We know a lot of people are frustrated with bonds. Everyone's been frustrated with them. They came off of an Armageddon basically for the last 4 or 5 years. But going forward, we think that there's some of the most attractive assets to be in. And we're going to continue to add, and we're going to continue to hold for the most part.
Yeah, Bepin, I just want to jump in real quick because I think that the chart that you showed earlier, that tight distribution of returns based on what I love about the bond market in many ways is we talked about how like Orson Welles warned of Martians coming down and landing and all the crazy things that human beings will do to fantasize, and that a lot of that type of same emotion can cause stocks to whipsaw like crazy. You don't really see that same type of reaction in the bond market to a degree for two reasons. One, bond investors tend to be a lot more level-headed because they tend to be mostly institutional buyers. But I think another thing is that it's just simple math. Like there's a mathematical underlying driver to the bond market. So when rates are really high and they tend to come down, like it's going to push the price up. It's kind of like gravity and anti-gravity. You can't fight it, right? So I think that's to your point, Beth. And I think where we're looking at the different parts of the bond market, are some of our confidence in our projections here comes from the fact that we don't think that we're going to wake up tomorrow and physics are going to somehow change in financial markets.
Exactly. No, and it's just a matter of time. Rather, it's when, not if. And that's why we're positioning ourselves for that when. So really, one of the biggest changes I say over the last 6 months of this year has been all the talk around the one beautiful bill, or one big beautiful bill. My apologies. Now this chart on your screen is quite busy. We're not going to go over every single one of these line items, but if you want to read it, feel free to pause the video right now. Go ahead and read all these different line items in here. The general changes, overall, the overall arching response to this is that we're going to have more money in our pockets. Almost every American is going to have a tax cut coming out of this. Primarily, we're going to see a little bit of an increase in the standard deduction. The biggest one that'll be affecting you as a senior citizen will be that they're increasing the senior standard deduction. You're going to get an extra $6,000 per person. And now the way we kind of talk about this is this kind of like a replacement for the promise that they would cut taxes on Social Security. They were not able to get that through, but for the most part, if you get an extra $6,000 here per person, I mean, a married couple is looking at 15,200 in senior credits, an extra 12 grand. And if you look at your Social Security, the max that can be taxable at is about 85% of your benefit can be taxed. And quick math, let's say 4 grand times 12, 48,000. Basically, your tax, if you're in Michigan, it turns out, or sorry, not Michigan, but federal taxes, if you're in the 22% bracket, turns out to like $8,000. So for the majority of folks, they're going to see their Social Security tax almost eliminated from this. Other big talking points here would be the SALT deduction. Again, for Michigan, that's not as big of a change for us, but it went from 10K to 40K. Tax on tips, tax on overtime pay, those are all getting deducted to some extent. Basically, the big piece here is that everyone's going to have more money in their pockets, and that's a big tailwind to the U.S. economy because if you'll recall, spending is the #1 driver of GDP, and people spend almost every dollar that they end up saving, So if they get a few extra dollars in their pocket, that's going to lead to a few extra dollars in consumption, which is going to lead to a few extra dollars in earnings statements, which is going to lead to a few extra dollars on the share price, which all feeds into eventually a new all-time high potentially. So this is probably going to be the biggest tailwind, I'd say, for the economy going forward, is that we're all about to have a lot more money in our pockets and the tax man isn't. So we expect this.
70% of our economy is consumer spending, right? And then, I think it's funny, not funny, but I think it's interesting, rather, Bepin, that, you think about all the talk about how, going into the summer months, people weren't going to travel and they were all panicking about tariffs and how consumerism was going to shut down. And what did we get last week from Delta Airlines? Record profits.
Travel has not slowed down one bit.
Not even. And I'm telling you, I'm on the road every week. It is full force right now.
It's insanity. People have money to spend. I mean, you go to restaurants, you go anywhere, you go out to the movies, you're going to see that place packed. And again, these tax cuts are going to just help exacerbate that. There's going to be even more money flooding around in people's pockets. And again, that's just going to end up being spent for the most part and contributing to overall growth in our entire economy. So very big tailwind going forward. I'd say this is probably one of the biggest pieces of change that we saw over the last 6 months outside of maybe like, let's say, tariffs, but this would be number 1 or 2. This, I got the lucky, I picked the short straw here and had to get all the tax talk, but this one is a little bit off the beaten path in terms of what we've been talking about so far today. But it's very important for Michigan retirees in particular. What you're looking at here is a chart. It's a little confusing, but really what you really should just be focusing on is that 2026 and thereafter, that far right. This is showing that going into next year, IRA, pension, almost all pre-tax withdrawals or distributions to you will be exempt from state tax up to a certain limit. If you're wondering, well, what about my birth year? I file it jointly. It's going to be based off of the oldest of the two. And what you're going to be able to do is be able to deduct a certain amount up to the max. We have it written in here somewhere, but I can say it in the second here. But you're going to be able to write off up to about 65,000 for single or 131,000 for joint towards your state taxes. So for majority of people, that's going to cover almost all of their pre-tax income, all of their IRA distributions and their pensions. That's going to be protected now from state tax. And I mean, the biggest reason we're doing this is because of we're trying to stop that snowbird trend. A lot of you are the reason we are doing it. You retire and the first thing you come talk to us about is I want to get a condo or I want to go buy a house in Florida and it's going to help me save on taxes. Well, Michigan doesn't want to lose you guys as a tax base. So if that's one of the biggest drivers of getting you out of our state, they're trying to combat that. Now, one thing to also look at is if you qualify in here based on your birth year, this year, you could already be having about 75% of that amount that I talked about, which is 65,000 for single and 131,000 for joint. Up to 75% of that you can deduct off your state tax bill. Now, I'm sure you're gonna have some questions saying, well, should I adjust my withholdings right now? I think the state of Michigan has recommended nobody adjust any withholdings. Continue to pay taxes as if it was all taxable. And then at the end of the year, you'll just get a deduction or a larger refund back just until we get to at least 2026. Now, once we get to 2026, that's when we can start adjusting withholdings once it's been locked in there. Another reason why you shouldn't just go off of, you shouldn't start adjusting your holdings now is due to that max deduction. So that's a moving target. Every year it's going to change with CPI, whatever the US CPI official number is at the end of the year. That's how much that max deduction will increase by. So if you are over that amount in terms of how much income you're going to pull out in a year from pensions and IRA sources, definitely don't mess with your withholding. The last thing you want to do is underpay the government and have them hit you with a penalty. So for right now, just keep going as you've been doing in the past, but just keep an eye out that in the future here, starting next year, majority of your IRA and pension withdrawals will be tax-free on the state level. So again, that's just another tailwind, not so much for the US economy, but it's fantastic news for you Michigan retirees. And it's very surprising how few people actually have heard anything about this and how little fanfare this has gotten. This is a dramatic change in the tax structure for a lot of retirees where, I mean, theoretically, if you're living primarily off of pension and IRA distributions, you're going to have a state tax free now. You won't be paying state taxes. We're going to become like maybe the next Florida, but we'll see. Maybe if we can just get the sun to behave or change the weather a little bit, we might be really able to keep all these snowbirds. But just keep an eye out for this change. Obviously, going forward here, we expect the rest of this year to potentially be more volatile as we saw in the first half of this year. But like me and Mike have been saying here, with the tax cuts, earnings growth, we have potentially the golden age of 4 different revolutions occurring at once. We don't expect that to stop. There should be volatility as always through the back half of this year, but we expect things to keep on moving upwards. Obviously, in the market, we'll be monitoring, we'll be paying close attention, making changes as needed. If you have any questions, any concerns, always feel free to reach out. Thank you for tuning in. Have a great rest of your day.